Welcome to the 3 in 10 podcast. I'm Scott Slayton, partner and chief strategist at Capital Creek Partners. In each episode, I'll give my brief perspective on 3 things we think market participants need to know this week, and we get it all done in 10 minutes or less. For additional resources and analysis, please visit our website at capitalcreek.com. Welcome to the 3 in 10 podcast for Friday, June 5th. We're recording at 2:45 p.m. Eastern Daylight Time, and this is episode number 56. So here's your starting lineup. Removing the punch bowl, we make the case for a Fed tightening cycle. Number 2, Broadcom earnings, the burden of great expectations. And number 3, the May non-farm payroll report, further evidence of labor market strength. So back to the top. On the Fed, we published a report this morning entitled Removing the Punch Bowl, where we make the case for a Fed tightening cycle beginning later this year. Evidence is building for this rate hiking cycle. We wonder if the Fed has the courage to get ahead of the curve before inflation begins to accelerate beyond a point where they really have to go hard and tighten. So inflation is accelerating in our opinion. Economic growth is strong. AI-driven animal spirits appear to be on the verge of getting out of control, at least until today's smackdown. And we know that this view is way out of consensus, right? This is not a consensus thought that the Fed should begin to embark on a tightening cycle. The market is now pricing about a 12% chance of a rate hike in July. We would put those odds at about 1 in 3, or call it 33%. So we think the odds are much greater. But this is complicated by the new Fed Chairman Warsh and the Lisa Cook case, which has been hanging out there since January. It increasingly looks like the SCOTUS will make a decision on the Lisa Cook case by the end of the month at the latest. So here's our evidence and why we're making the case that a rate hike in July should at least be on the table. Number one, the 2-year Treasury note yield is now about 60 basis points above the federal funds rate. That's more than 2 25 basis point hikes. So the 2-year is always our leading light on where the Fed funds rate is headed. Not Fed rhetoric, not their beliefs and their forecasting. We don't believe in their forecasting. We believe in the 2-year note yield, and that yield is way above the Fed funds rate, and that's telling us they need to hike. Now, number 2, the ECRI Future Inflation Gauge, which is the best gauge of future inflation, a leading indicator of inflation, is in a confirmed uptrend and telling us that the risk to inflation is to the upside. And we're seeing that come through in the data over the last few months. The war with Iran, we know that wars are both stimulative and inflationary in nature almost every time. We see inflation expectations. The Michigan survey is now telling us that the 5 to 10 year, the intermediate to long-term expectation by consumers for inflation is now above 200 basis points above the Fed's 2% target. Now, the Taylor rule, the Fed's own Taylor rule, is now indicating much tighter policy is needed by the Fed if the Fed truly wants to hit its 2% target. We are beginning to wonder if they really do want to hit the 2% target, or if they would be thrilled if they could just get it back down to 3 and keep it there. We know the labor market is firming. The non-farm payroll number today made that very clear. And we know we've got inexorable fiscal deficits as far as the eye can see, with no will in Washington to address those whatsoever. So we actually think that the Fed will not tighten on the 29th, but we think they probably should, because when you fall behind the curve on inflation as a central bank, you must hike more and faster to catch up. And we certainly hope that is not what happens to this Fed. If a hiking cycle begins this year, we do not expect it to be a one and done. We expect a true cycle with 3 or 4 hikes to end up taking place, essentially just taking back the 3 cuts that they made in the second half of 2025 that they probably shouldn't have made because they never got down to their target before they started cutting. So my expectation would be 3 to 4 25 basis point hikes beginning probably in the fall of this year and extending into 2027. Now on Broadcom and the burden of great expectations. Broadcom reported fiscal second quarter 2026 earnings of $2.44 per share. The consensus was at $2.40, so a relatively modest beat. But we were listening to this call to understand what we could glean about the AI CapEx cycle, and management did not disappoint us. Full year AI-related semiconductor revenues are expected to reach $56 billion. That is up 180% year over year. That is quite incredible in our opinion, coming off numbers that large to up 180%. More importantly here, fiscal 2027 AI semiconductor related revenues should be well above 100 billion. So probably doubling again next year to a pretty darn big 100 billion. Now, gross margins slipped a little bit in the quarter from 77 to 74. We're not so worried about that. EBITDA margin is still a very high 69% in the quarter. But the key to us that we learned in this quarter is that the book-to-bill ratio for Broadcom is approaching 3. So for every dollar that they're billing, they're getting $3 in orders, and that creates very high visibility. And the management said high visibility through 2028. So we're talking 2.5 years of visibility. That tells me that the boom in AI CapEx still has legs. They received purchase orders from 2 new clients, diversifying the buyer base here, totaling $6 billion. Those are some pretty chunky orders for brand new clients. And the average, here's another thing the management said that really captured our attention. The average selling price for chips is accelerating to the upside. So we know Moore's Law has been in force for over 50 years, and we've learned that for decades that semiconductor prices come down methodically, inexorably, but not right now. Demand is so far in excess of supply that prices are accelerating. And so, bottom line here, I learned nothing in this conference call that leads me to believe that the AI boom is slowing. I guess that's good news. It may be running too hot for now, but it looks like it's going to continue, at least based on comments from Broadcom. Now, number 3, the non-farm payroll report. Further evidence of labor market strength. The headline was an addition of 172,000 jobs, basically 2 times the expectation from the street of 88,000 jobs. And April was revised sharply higher to 179,000. So the last 2 months have been really big additions. And for context, the Fed believes that the equilibrium in terms of payroll additions needed to keep the unemployment rate steady is 0. So we're running way above 0. And I like to focus on the 3-month average. So what is the average of the last 3 payroll reports? That's now 188,000. Very robust. Average hourly earnings were healthy. They did not go up a lot more than expectations. They came in right in line at plus 0.3 for May and plus 3.4 year over year. Now, I look at that 3.4 and I back out 2% for productivity gains, and maybe more than 2%. And that tells me wages are not out of control. Wages are the weakest link in my Fed tightening case and the case for higher inflation. We are not seeing it yet in wages. In fact, we're still seeing some disinflation in wages, which is really good news. Now, the unemployment rate remains steady at 4.3%. That is practically unchanged for the last 2 years. But this is not, make no mistake, this is not a Goldilocks number this morning. This number is too strong for that. And you can see it in the Treasury market reaction. The 2-year Treasury note yield would not be up 12 basis points today if this was a Goldilocks number. So the payroll number will have the increasing number of hawks on the Federal Reserve Board buzzing. And the June 17th meeting is set up to be very interesting, as it will be Chair Warsh's first meeting. So I wonder, will the Fed step up and put a July rate hike on the table as a possibility? I wouldn't count on it, but let's wait and see. Do the work, endure the fog of war, and have investment prudence.
The information in this podcast is educational and general in nature and does not take into consideration your personal circumstances. Therefore, it is not intended to be a substitute for specific, individualized financial, legal, or tax advice. To determine which strategy or investment may be suitable